A lot has happened in the first half of this year, and in this video, I'll be going through number 1, how the funds that we had invested had performed. Number 2, previous actions taken and future actions that is expected. Number 3, fundamental analysis and the expected annual return of our investments. And number 4, market expectations for the second half of this year. Without further ado, let's get started. Now let's talk about the fund performances first. In the first half of this year, all the funds that we had invested experienced a recovery, with the S&P 500 taking the lead. Now the stellar price performance of the S&P 500 can be attributed to the positive economic data of the United States, as well as a shift in investors' confidence as investors become more aggressive, driven by the hype surrounding the artificial intelligence stocks. Now the disappointing price performance of the Asian equity can be attributed to the lackluster economic data from China, which had fallen short of what analysts were expecting given its reopening narrative. Now I've covered the topics in greater detail in my 2023 first half market updates, so please read that report first before going into this video. Now here's how my portfolio, which is identical to how I advise you guys, have been performing. For individual performances, please refer to your own investment accounts, as the return may vary depending on when you start investing and also the extent of which you follow my actions when we bought the dip last year. And that brings me to the next topic of what are the actions taken. Now no actions were taken for the first half of 2023, as prices has yet to reach my third price target to invest the amount that we had previously sidelined back in 2021. That's it. If you've only started investing with me in 2020 or 2021, this portfolio action does not affect you due to the limitation in portfolio size and implementation. As a refresher, we are currently invested the first two parts of the funds that were sidelined, which accounted for around 60 to 70% of the total amount of the funds to be invested. For the remaining 30 to 40%, I'm still adopting a wait and see approach. Now I will be deploying the remaining funds should either the prices come back down to hit my third price target or if fundamentals improve for the better. Thus far, the fund that we have reinvested is only limited to the Asian equities, as valuations are attractive in the Asia region, given how beaten down they are over the last 2 years. As for the global equities, valuations are somewhat neutral and not attractive enough for me to consider investing in on a lump sum basis. But we will be rebalancing our allocation again as the market normalizes, moving into the later half of this year and perhaps sometime next year. On the topic of fundamental analysis, from the angle of the price to earnings ratio, these are the findings for the global equities as represented by the S&P 500 and the Asia equities as represented by the MSCI All Country Asia Pacific Index. For the global equities, valuation has come back down to its long-term average given the correction last year, coupled with a resilient earnings in 2023. Now, despite having the risk of the most anticipated earnings recession looming around, the economic data and investors' attitude seems to suggest otherwise. It's truly a weird time to invest. Now, given what has materialized over the first half of 2023, my stance towards the probability of an earnings stagnation as opposed to an earnings recession has since shifted to a 50-50% probability. Now, what this means is that should the United States successfully pull off a soft landing, which consensus now is that they won't, we will then initiate a portfolio rebalancing to revert our portfolio allocation to its strategic allocation levels of 70% in Asia and 30% in global equities. That's it. This will require the dust to settle, which will take around 6 to 9 months after the Federal Reserve has completely stopped its rate hikes. Only time will tell. On the other hand, for the Asian equities, while prices have recovered slightly, valuations continue to remain depressed at the back of China's disappointing reopening data. Looking at the earnings and price behavior, while the decline in fund prices is not fully unjustified, I feel that the extent of the decline is exaggerated as a result of mass panic and exit away from China and Asian market during 2021 and 2022. While the earnings may continue to experience a decline as a result of a slowdown in the global economy, the depressed valuations will provide a strong case for further upsides in the market. Now, what is missing for a recovery to occur in Asia is a strong investor confidence, which will eventually recover as the global economy stabilizes. Now that we've understood where the two markets stand in terms of valuations, the next thing that we'll be looking at is the projection of performances, based on the outcome of my relative valuation model. To smooth out the short-term volatility and noise in the data, a 3-year rolling average data will be used for the calculation and projection of the earnings per share. For the global equities, based on an earnings per share growth rate of 4 to 6% and a fairly valued market environment, the expected annualized return over 5 years is negative 0.2% to 1.7%, while the expected annualized return over 10 years is 1.86% to 3.82%. For the Asian equities, based on an earnings per share growth rate of 6 to 8% and a fairly valued market environment, the expected annualized return over 5 years is 9.5% to 11.6%, while the expected annualized return over 10 years is 7.76% to 9.79%. From the above finding, it is clear that the expected annual returns are pretty decent for Asian markets, as investors can buy into the future growth of a developing region at a very low valuations. Therefore, the expected returns by investing in Asia today are driven by both valuations and earnings revision that will happen as we revert back to long-term average levels. On the other hand, for global markets, as the market is already trading at its fair valuations, the investors who are buying into the global equity today at this price will be able to only earn a return from the fundamental growth itself, which is expected to be lower than the Asian market given that the global markets comprises mainly of developed markets that are unable to grow at the same pace as the developing markets itself. Lastly, let's talk about the portfolio expectations moving into the second half of this year. Now, while the future expected returns looks decent, I do not foresee them materializing anytime soon, at least not within the next 12 to 18 months, as I expect the markets to remain extremely volatile as a result of the economic headwinds. Now, what this means is that the short-term price action will not be that sustainable in the long run until the headwinds are addressed. On the topic of when the market will experience a sustainable bullish price action, this will only be possible if investors' confidence recovers, which I have previously mentioned in my market expectations for 2023. If you have any questions pertaining to the portfolio itself, do drop me a PM and we can set up a meeting online to address any questions or concerns that you may have. Hang tight for the recovery and I'll see you again in our next annual review.